Fitch Ratings has affirmed India's sovereign credit rating at BBB minus with a stable outlook, citing the country's robust economic growth. Fitch Ratings on Monday affirmed India's long-term foreign currency issuer default ratings (IDR) at BBB minus with a stable outlook, noting that the rating is underpinned by the country's robust growth prospect and solid external finances. The agency said India's economic outlook remains strong relative to peers, even though momentum has moderated over the past 2 years. It forecasts GDP growth at 6.5% in financial year 2026, unchanged from financial year 2025 and significantly above the BBB median of 2.5%. Fitch also added that they will continue to be driven by strong public capital expenditure and steady private consumption, although private investment is likely to remain moderate due to risks from potential US tariff hikes. And to discuss this further, I'm joined by Karthik Malhotra, Executive Editor. Karthik, take us through what is exactly the significance and what are the key factors that drive the Fitch's decision to affirm India's ratings?
Hi, Samir. So I think to be clear, one must understand clearly that there has been no change in the stance that Fitch has kept on India's economy. It was BBB negative. It continues to be BBB negative. But this now comes again in line again after S&P Global had moved India a notch higher from the BBB to the BBB negative. So that movement and now coming in line, of course, with Fitch for the second time saying that it continues with a BBB negative, it just sort of becomes an assurance to those who are looking at parking money in India, those who are looking at investing in India, and those who are looking at lending to India potentially from outside the shores of the country. It is a sense of assurance that India's chances of defaulting on that loan is fairly low. So that is pretty much the significance of this reaffirmation of the BBB negative. But I think what is important to deep dive into the story is the fact that it continues to hold India's growth prospect at 6.5% for this current financial year, FY26. This is coming exactly in line with RBI's forecast of 6.5% for India's growth in this financial year. Now, what you're seeing changing is that credit rating agencies in the past had some sort of a divergence with India's own growth assessments. So earlier you saw that credit rating agencies kept a slightly lower horizon when it came to India's overall growth prospects. Now that is coming absolutely in line with what the RBI has projected. So that is one thing to read into. Second, I think, no surprise there because India's forex reserves are good to cover about 11 months of India's total requirements. So at about a little short of $700 billion, India is holding enough forex that it will be more than easily able to pay for any exigencies, any contingencies which arise from outside of India. So I think most of these factors coming together, and now S&P also in line with the Fitch ratings for the second time at BBB negative, means that there is better surety of any loan being given to India being paid back as expected.
Also, Karthik, how does Fitch assess India's external finances and what are the sectors that are driving India's finances?
Right. So I think, a lot of this momentum right now, Samia, also comes from the fact that we are looking at reforms. We are looking at manufacturing, India's push towards manufacturing. There has been a lot of public-driven capex investment in India over the last 5 years. In fact, ever since you saw the 2020 COVID-19 pandemic and how India has been able to keep its economy on track, a lot of that came from the fact that India invested a lot of its resources in building infrastructure. So if you look at the equation of a country's GDP, public capex is a large constituent of that, and that is something which has been robust in the case of India. So India has been able to invest thoroughly in building public capex through infrastructure development that we are seeing, and that is something which Fitch is also taking into account. So even in its current rating, it continues to be bullish on public infrastructure spending to continue. However, I think one of the areas of concern is private capex, and that private capex, what is referred to as animal spirits by corporate India, that is something which could potentially still lag in the country. However, that will be more than offset by the likelihood of growth in consumption, and that growth in consumption just got another shot in the arm with the next gen GST or the GST 2.0 reforms, which have been cleared by the group of ministers and would be presented to the GST Council to go ahead and implement, potentially some experts feel as early as the 1st of October.
Absolutely, Karthik. But one area of concern, if I could point it like that, is that Fitch also goes on to say that even though there is going to be public capital expenditure that is going to be strong, but as far as the private investment is concerned, that is likely to remain moderate due to the risk from potential US tariff hikes. So US tariff hikes is going to be holding like a cloud over India's growth.
Yeah, so, I mean, again, what I was talking about, the animal spirits of corporate India, that is the entire theory of private sector making those capital investments. Now, again, what does private capital really require? Anytime a company decides to pump in a few million or $1 billion into infrastructure or into, let's say, setting up a new factory or starting a new line of production, I think what is absolutely essential is for the investor to understand that there is going to be a stable environment and there is going to be continuity in business. Now, as far as India looking at its internal condition is concerned, I think India is fairly confident that there is a large consumption market, there is stability in government policies, there is continuity of the government. But when you look at the external environment, that is in a bit of a flux right now. So companies which are, let's say, catering to US as a market, would they want to double down on their investments in India, make in India to export to the US? Well, that seems to be a big question mark which is looming over private capital expenditure right now, because you don't know how fickle that policy is going to be. You don't know how quickly decisions taken in the US could change. And that is something which is going to keep investors, especially the private sector, which is looking at increasing its capacity, is going to keep them guarded, is going to keep them on the edge until they're absolutely assured that the investment that they're making is actually going to yield them results given a more stable global outlook. And that global outlook does not seem to be as stable right now, Samya.